Morning, everybody. Today we have James Kholamian from GK. He is going to discuss opportunity zones with us, and they have a current offering in Sarasota, Florida, which I think is pretty interesting. It's in downtown Sarasota, and we're going to give him some time, and then we'll do questions and answers after his presentation. If you want me to ask, you can just hit me up in the chat box and I'll ask the question for you. But James, I'm going to turn it over to you. Feel free to discuss your offering and opportunity zones.
Great. Thank you, Mark. Thank you, everyone, for coming to hear about our project today. So I'm James Kholamian with GK Real Estate. And so I want to talk to you guys about our opportunity zone offering for a luxury multifamily development in Sarasota, Florida. To start, I'm sure a lot of you already know about opportunity zones, but I'm going to quickly go over them again in case you're not. So opportunity zone legislation was created in 2017 as part of the Tax Cuts and Jobs Act. And it's essentially a way to bolster growth in designated areas across the country. So states were able to designate certain areas as opportunity zones, and development projects done in those zones that qualify and invest enough money are able to shelter the gains of investors that invest in those areas. So the core benefit is when you create a qualified opportunity fund, which is what we're offering, gains that are from selling real estate, stock, selling a business, any capital gains you have, they're invested in that, that qualify within 180 days from when you realize that gain, gets two major tax benefits. The first is you get the deferral of capital gains that have been invested. So let's say you had $1 million in gains, you had a 25% tax rate, you invested all $1 million in the Opportunity Zone Fund, your $250,000 tax bill would be deferred until the 2026 tax year, payable in 2027. But you would own $1 million position in the Qualified Opportunity Fund. The second part, and the most important part, is that there is the permanent exclusion of taxable income on new gains. So if you hold the O zone for 10 years, upon sale of the asset after that 10-year hold, the basis is reset. So all that appreciation over a decade is not taxed on the sale. So that is the major strength of the opportunity zone, and it's approximately 80% of the tax benefit. So when you look at opportunity zones, the thing that we like to think about is that if your main benefit is that appreciation, then you should be trying to maximize how much your asset's appreciating over those 10 years, because that's where the majority of the benefit is. So if you go into a deal that's, got a really, kind of safe and steady return, and you hold it for 10 years, that appreciation is not going to be as beneficial as if you go for something with a high internal rate of return and you could really maximize the tax benefit. So that's kind of how we structured this project, as a single asset, projected high yield opportunity zone. So on top of the basics of the opportunity zone legislation that's been in place and people have been raising money for the last few years, there is new legislation that's been proposed. It's called the Opportunity Zones Transparency Extension and Improvement Act. That's been proposed by a bipartisan group. And the core element of that act that appeals to us and would affect our projects is that they want to push out the deferral period for 2 more years, from 2026 to 2028, payable in 2029. We've heard a lot of things in the industry and from lobbyists that this seems to be moving forward. So hopefully in the coming months we can see that pass, and I think that'll have obviously a beneficial effect on all of us in getting a further deferral. So there's an overview of opportunity zones in general, and we want to talk, of course, about our project. So this is the GK Opportunity Fund 1. It's a qualified opportunity fund that is investing in a single luxury multifamily development in downtown Sarasota, Florida. So we've already purchased a 1.39 acre site. It's a designated opportunity zone by the state of Florida. It's in downtown Sarasota. If you guys are familiar with the market, it's just south of Ringling and on the corner of Washington. So this is essentially a 20-minute walk to the bay and a 15-minute walk to the downtown core shopping loop. So very close proximity to everything you'd want in a residential apartment in the Sarasota area. On top of the the prime location. The city did a sweeping zoning change recently, and so now we're zoned to build 242 multifamily units on our site. So we have been developing the city of Sarasota for several years. We're just finishing up a condo development in the downtown right now. So we're already started the design review committee process. So that's how you get your project approved in Sarasota. We went through the first round of comments a month ago, and the second meeting will be in mid-May. So that's sort of where we're at with the project, right? So mid-May, we get design review committee approval. And then from there, we go to permitting in June, with permitting taking about a little less than a year. Groundbreaking scheduled for March 2025. Construction through the end of 2026, with lease up and stabilization occurring into early 2028. So with that timeline, obviously the question is, what about the deferred 2026 capital gains taxes? So there's a lot of strategies that funds are doing to try to give investors cash to pay their deferred capital gains. The most popular idea is that we're going to do a cash out we're going to do a cash out refinance in 2026, give you guys a bunch of money back to pay your gains, and it'll all be great. The problem with that is every opportunity zone in the country is going to be trying to do a cash out refinance in 2026. And it's not necessarily something that you can just snap your fingers and do. It depends on what interest rates are at the time, what the value of your real estate is based on the cap rate market conditions at the time, and a number of other concerns. And for us, because of our timeline of construction, we likely won't be doing a cash out refinance by the 2026 tax date. What we do plan on doing is a cost segregation. So what that does is we accelerate the depreciation on the asset, and we spit out a bunch of losses in 2026 as soon as it's built. And depending on your tax situation, if you have a lot of gains that year, it might not be as helpful. You should get some losses that you can use to offset that deferred capital gain. But regardless of all these strategies, investors should, in their minds, think, all right, I need to be prepared to pay those deferred capital gains in 2026, because ultimately it is a benefit to defer those gains. The core benefit of the opportunity zone is that appreciation of your full investment over 10 years. If the extension passes and pushes the timeline out to 2028, that offers a lot more options, and it may have, your refinances are not all occurring in 1 year, and it spreads things out. So that could be a benefit as well. So talking about our offering itself, the offering is a Reg D offering to accredited investors only. It has an 8% preferred return that starts accruing as soon as you invest. So the day you invest, your 8% pref begins ticking. That 8% pref will accrue until we stabilize in 2027 and 2028, and then should start cash flowing. So for a chunk of the project, you're accruing, but then for a good chunk of the project, you're also getting regular payments from the investment out of the cash flow from the property. Then obviously we hold the project for 10 years from when the last investor comes in and move to sell it. So it is an expected 10-year hold period. The offering is raising $50,500,000. Our GK principals and people around the office here have put around 1.8 million of their own capital inside the deal alongside you. So as investors in the fund, completely the same. The cost per unit is $50,000 per unit with a half unit minimum. So you can go as low as 25,000. So that's kind of the details on the offering itself. But obviously we're most excited about just the project. So we were sort of amazed that this site was an opportunity zone. Sarasota is a extremely fast growing market. It's filled with luxury condos, but there really hasn't been a lot of luxury apartments. So when we saw this site in the downtown designated an opportunity zone, we snatched it up. So we bought it for a very good price. We bought it actually 3 years ago. And so right now in our pro forma, which you'll see in the PPM, we project a net investor IRR of 16.37%. Obviously, these are projections. We're predicting 10 years out, but that's a really great IRR. And when you look at IRRs, they're calculated over time. So the longer that you hold an asset, the lower the IRR should be. So when you have a high teens IRR over a 10-year period, it's a really huge growth opportunity. So with that projected IRR, we're looking at a 4.19x multiple on the equity invested over the 10-year hold. So for a, an imaginary $1 million gain investment into the deal, you would potentially earn 4.191 million at out year 10. That includes your pref, your return of capital, and all the gains from the sale after year 10, and you would pay no capital gains taxes on that. So that's the reason why this structure of the opportunity zone is so useful for it's so important to focus on yield, because that's how you're maximizing your benefits, is you're really growing this and you're not paying taxes on that growth over 10 years. So obviously these numbers sound great. Like obviously we all want to make that sort of return over 10 years. So how are we substantiating this model? Where are we getting these returns? So obviously your model is an assumption of the future that's really boils down to what are your costs and what are your revenues, which are obviously both estimates. But I'm going to kind of go through where we're getting those estimates and why we feel confident in using them. First off, financing. Financing is the bane of projects right now. Financing has obviously gotten extremely expensive as rates have increased. And right now, construction debt is looking at 8-9% plus. Very expensive money, and construction costs have risen a lot. So that makes it hard to make projects pencil. Luckily for us, we have decided to go the route of HUD financing. So HUD financing is subsidized financing through the federal government and offers far better rates and several useful options, as long as you have a small affordability component, which we already have included in our project from the city's new zoning code. So with the HUD financing, right now the rates are around 6.25%, way better than what you can get for normal construction debt. On top of that, you have the option to reset your rate anytime you want as rates change, or keep it. So if rates go down, you can reset your rate. If rates go up, you just keep what you've got. It's a really beneficial structure to the HUD. On top of that, it's a 40-year amortization and it's assumable by the buyer. So that's a huge value. So if we do this HUD financing and in 10 years we sell it, you've got 30-year debt at the HUD rate that you can do the same thing. You can, reset your rate again as it changes. That's a tremendous value. So on top of being this luxury project in a great market, you've got this really beneficial financing that increases the value over time. The way that it works is also an automatic roll from construction to perm. So you get the HUD financing done, you go straight into construction, and it rolls right into perm financing. You don't need to find a new lender or deal with any of that. You can also refinance within the HUD financing. So there's a ton of benefits. We've already been pre-approved for HUD financing. We've hired a HUD financing consultant, and we're going through that process now to get that funding secured, which takes about a year. So we started in January. So that's where we're getting our financing for construction. Because this project is 200 plus units, you suddenly get into a world of much bigger, better, high quality third-party groups. So our contractor is Cast Construction. They're a premier builder in Florida. They built over 8,000 apartment units in the state. They have built tons of multifamily units just like ours, of the same scope and size. And they know all the local Florida subcontractors, which is a big deal because everyone's competing for subcontractors. So you got to be the biggest guy with the biggest network to get things done on time and at the best price. So our construction budget is based on their estimates. So that's what we're using for our costs. As for the details on the lease up and the timing of leasing and all the revenue oriented estimates, we brought on a third-party property manager, Asset Living. Asset Living is a massive multifamily property manager. They manage $30 billion of properties nationwide, 225,000 multifamily units. So they're the ones who are giving us our projections on how long is it going to take to lease up, what are the costs of leasing, what are the fees that we can get on other things. So that's where those numbers are coming from. Then we've got our unit mix. So we brought in OKW Architects out of Chicago. We've worked with them many times on other projects. They've done a lot of high profile builds across the country. They developed the IKEA in Chicago. They're in every asset class. So we had an original architect who had laid out our space. It wasn't really working. OKW came in, optimized it to add way more units, that laid out way better, and really maximize the use of space. So they build our unit mix, right? So now we've got our unit mix. We know our cost of construction. The last thing is, well, where do we get the projected rents? So we did a third-party market study with a group called Tracy Cross, and they basically look at the market, take comps of all the other units, and they give you a projected rent number. And this is the kind of rent that when you're going to get financing, when you're going to all these groups, they need that number substantiated. So that's where our revenue estimates come from. So all of those numbers and all those substantiated inputs are what we use in our model to get that projected return. So we feel confident in saying, this is the sort of deal we're offering, and this is why we, think we can really maximize the growth of an opportunity zone investment. So why Sarasota? Of course, we have this great project. Why did we choose the Sarasota market? So Sarasota is obviously a fast growing market. You want to be in a growth market. Florida itself is one of the fastest growing markets in the US. It's a business friendly environment. It's a tax friendly environment. And Sarasota itself is interesting. So we are building a luxury condo in Sarasota, which we'll be delivering in June. And condos were the majority of what the residential development was in Sarasota for a long time. It was a place where wealthy people moved and bought condos. There wasn't a lot of apartments in the area, and there has been a lack of delivery. So when we did our Tracy Cross market study in January of 2024, there were no new luxury rental communities delivering units to compare. The last delivered apartment project in the area delivered in 2020. So for a long time, the area has been underserved. So now that the zoning has changed, more of us are coming to bring in that multifamily demand that this market needs. And then, of course, as the market itself has just been growing really nicely. U.S. News and World Report rated Sarasota as the #1 best place to live in Florida, and the #5 best place to live in the entire United States for 2023. So when you're picking a project that you're going to be holding for 10 years, obviously it's important to choose something that is in a market that you feel comfortable with over the long term. So we love Sarasota. We love this site. We feel really strongly about our market fundamentals. It fits really well into the structure of the opportunity zone with a lot of potential for growth. And then I'm just going to kind of wrap up with a little bit about us. So GK is a private real estate company. It was established in 1995. We've been around for 29 years. My dad actually is the founder, so we're a family business. We have been through many market cycles in every asset class. As a sponsor, the markets really dictate a lot of the investment experience. And having survived through 2008 and all of these things that have happened has really grown our, ability to navigate whatever financial situation comes up. We owned several malls and retail properties through COVID and made it through all of that. So we definitely have the experience and the know-how and have been around for a long time. We're a boutique firm. We have 25 employees. We're based in the Chicago suburbs. We like to laser focus on doing something very well and very tightly, oriented. So there's a lot of opportunity zone funds that might have 20 projects in them that are like by these big groups, and they're spreading their risk and they're working on a lot of things. For us, we're that boutique firm. We find one really good deal and we put all of our energy into that because that's how we operate. And so that's sort of the experience you get with our products. We're also vertically integrated, so we do our own asset management, property management, leasing, financing, capital raising, and then we bring in experts where it makes sense. So obviously here, we manage a lot of our retail properties, but if a multifamily property in Sarasota, Florida, we'd rather have a big group like Asset Living to manage there. So they obviously all report to us in the end. So this is our fund. It's open and available now. As soon as you invest, you start getting your 8% pref. We've already, our senior executives, when they have gains, they've been putting cash into it. They put 1.8 million so far. We really like the deal. We love the market. We love the area. We love the potential for growth. And we would love to bring you guys into our project. So that sort of wraps up my talk. And I will now go and look at what questions we have. Are you tearing down an existing?
Are you tearing down an existing structure?
So yes, the existing structure was some medical office space in a parking lot. We already tore down the medical office space, so it's been demoed, and the parking lot is existing until it's time to build. The environmentals were all done when we purchased the site, and when we demoed it, we'll have to do another environmental set when we go for HUD financing. But we've already done the phase 2s and everything's clear. Another question, how does our project compare with other ozone projects in Sarasota? I am not familiar with the terms of the Bell Point Opportunity Zone. All I can speak to is, what ours offers.
I got a couple questions for you. How many units was this originally zoned for? Because you said you got it upzoned.
Yeah, we originally acquired the site and it was only zoned for 69 units, which really only took up half the site. We spent a few years working with our neighbors and we put their density rights under contract and got it up to 139 units. And then all of a sudden the city came and changed the entire zoning code. So we didn't have to pay that on the extra zoning and got 240 plus units zoned for our property. So as of right now, we have the zoning. We are already halfway through design review committee. And we've already built a project in Sarasota, so we know everyone at the city, we know the contractors, we know the area, we know the process. I see another, so we are on AI Insight. We also just did a new fact right report. So we relaunched this offering with the new density in January with Mark and his team. And as part of that, we did a new fact right report. So there's due diligence reports and an AI insight on this asset.
Al just typed in how much capital raised so far.
We've raised 5.5 million so far.
Okay, I got a couple more. I think it probably is worth some background on how this land was originally in an OZ, because my opinion is the Sarasota downtown area is a very high-end area. And maybe you can give us some background on how this particular lot got in that zoning.
So Sarasota is a very luxury market, but it's surrounded by pockets of lower income, and how they determine the census tracts is sort of gerrymandered. The area, there's a municipal courthouse nearby and some other municipal buildings. So at the time, they were able to argue that this could be designated as an opportunity zone, even though, if you walk 15 minutes west, you're in like the heart of the downtown core. So we lucked out by the designation, and luckily, as part of the new legislation, they're trying to change how you can designate certain areas. The existing designations are grandfathered in. So it was lucky, and we snatched it up as soon as we saw the site come on. Because if this site was not an opportunity zone, we still would have bought it. It's such a good site and such a good market, and it's zoned correctly. So yeah, we lucked out there with the opportunity zone designation.
Okay, I got another one for you. You mentioned you're going to get HUD financing, and I think that's great because of the 40 years. But is there a cost to refinance that if rates go from 5.5 down to 4.5?
To change the rates, you don't actually refinance. It's a mechanism built into HUD, and there's not a lot of cost to that. To do a full cash out refinance is a little more nuanced. We haven't done one before, so we're still kind of learning that process. But the rate adjustment ability is hugely beneficial, and there's some small costs, but it's like 30-40 grand to just go through the paperwork and work with the HUD advisors.
Okay, here's another one. What percentage of the total units is low income? You have to set aside any of these units for low income out.
Let me look at my model. So when so HUD and the city both required some low income designation, but the best part about the city's zoning code is it's very generous with its designation. It's essentially a calculation based on average income, and when you look at the average income of Sarasota, it's quite high. So we have, of the 242 units, 26 of them are affordable units, and obviously those are almost all one bedrooms that are slightly smaller in square footage. There are some restrictions on how small you can make them, but with those affordable units in our mix, that's still in our model for the projected yield that we have on the project. It's not like Section 8 housing or anything. It's just affordable units.
Okay, so for police officers, firemen, stuff like that in the area, maybe.
Yeah.
Looks like we're out of questions. I only had a couple, but anybody else got anything before we call it a day on the conference call here? Hey, James, I appreciate your time. And
I just saw one more question. Are the units being structured so they can be sold as condos? Right now, we're not planning that because the problem with doing a condo conversion is then you need to go and sell all the condos individually, which is a time-intensive process. And because of the opportunities on structure, we wanted to hold it for 10 years and just sell the whole asset. And no matter, what time in history or economic system we've been in, Class A multifamily has almost always been a very desirable asset class, especially for institutional buyers. So the fact that this project is big enough, it's 242 plus units, it's in that great market. We feel that selling it as an apartment to a big institutional fund is probably the best play to realize the most gains as quickly and as easily as possible after the 10-year hold period.
I got another question. You're in Chicago?
Yes.
Yeah, I just saw some guy walking by. It looked like the mailman wearing shorts. It's nice there today. I expected snow.
It's 80. It's high of 80 today. It's finally here. We're loving it.
That summer, huh?
Although all of our executives are actually in Sarasota this week, so we might have better weather than them.
Okay. Well, I do appreciate your time today, and I'll let you get back to it. Al is still on here. Al, I just gave you my email. Send it to me, and I'll make an intro to James too. I'll send you our due diligence package on this.
Thank you, everyone, for your time. We're happy to do deeper dives on any questions that you guys come up with later. Yeah, we're excited about this project, and we'd love to work with any of you on it.
Sounds good. Hey, thanks a lot, James, and I'll let you know if we get anybody looking for more information. We'll send it to you and have you respond.